Hey, what's going on, everybody? It is Tuesday, April 5th. So the market got smacked today by comments from Lael Brainerd, who is the Fed Vice Chair, and she was talking about the Fed doing QT, quantitative tightening, very fast, and inflation is too high and there's too much risk. Like, there's a whole lot I could say about this stuff, folks. First of all, as I've said in prior videos, there's no such thing as QE or QT. They are neither easings nor tightenings. They are just a recomposition of dollar assets in the economy. So that's number one. Number two, inflation might be high, that's correct, but raising interest rates will not help that situation. As a matter of fact, it'll inflame that situation because the cost of credit is reflected in the cost of all goods and services. If you raise the cost of credit, that just, is going to flow through to all prices, and prices will be higher. So they have it wrong, but as you know, if you've been following me for any length of time, this is classic institutional central bank thinking. It is classic institutional mainstream economics thinking. That's what all these people have been brought up on. That's how they have been schooled. So it should not be any big surprise. What I'm looking forward to, I'm looking forward to the whole thing. First of all, with respect to today's sell-off, you know me, if you've been following me, I basically I ignore market reactions based on monetary policy because they're typically just the wrong reaction. And probably every single time that I've made these videos in response to some market move by a Fed comment, I say go against it. I was a buyer of stocks today, and I was very happy about that. I like when the market goes down because to me that is that's prices on sale, right? Like when you go shopping, if you have your favorite item or something that you want to buy and it's on sale and it's on a discount, that's when you buy it. You don't buy it when it's going up in price. So that happened today. Hang on. But the thing that I've been talking about now for the past, maybe a week or more is like, I'm really excited about what's going to happen with regard to monetary policy starting in May. The interest rate hikes, the quantitative tightening, we'll just continue to use that term, even though it's really not what it implies, because I want to see what's going to happen, from a number of perspectives. Number one, I want to see when they raise interest rates, what is going to happen to, number one, the inflation rate, as long as we don't see, for example, a big drop in oil prices, and I'm going to talk about that in a second, or a big drop in commodity prices, but mainly I think the thing is going to be oil. That has the potential to correct, I think, possibly in a sizable way. Starting to see some producers selling in oil over the last 2 weeks. So maybe they see something, maybe they know something. You got big Russian oil discounts being put out there on the market, and we're starting to see some inventory build. As a matter of fact, today we had a 1 million barrel inventory build in the API. But let me get back. So I want to see what's going to happen with the Fed rate hikes and the effect that is going to have on inflation. And my belief, my position is that's not going to help inflation. As a matter of fact, it's going to push it higher because, again, the cost of credit is reflected in the cost of all goods and services. If you raise the cost of credit, that's going to be reflected in, basically everything that we buy and consume. Number one. Number two, quantitative tightening. Again, this is not a tightening. This is a recomposition of assets in the economy. You're simply going to be having less reserves and more government securities. Government securities earn interest. The government is a net payer of interest, so necessarily, it's like a fiscal expansion because the government's going to be paying more interest into the economy because there's going to be those securities that the Fed was, previously stripping out and taking for itself. Those securities are going to be left in the economy earning interest, and that is a net transfer of income to the economy. I don't see how that's a tightening at all. I mean, when you're boosting income to the economy, that's just not a tightening. I'm sorry. So I want to see what's going to happen in that regard. And thirdly, to the degree that the Fed's balance sheet reduction leads to a reduction in reserve assets in the banking system, I want to see what the banks are going to replace those reserve assets with, and I contend it will be more loans. So, I don't see that as a negative for the economy either. Now, I may be wrong on all three of these things, but I think I have a pretty good understanding. And, like I've been saying, we got a real-time laboratory where we are going to be able to assess the outcome of these policies. And I believe that the mainstream view and the view from central bankers that somehow they have control over this through rate setting, number one, I don't think that's true. And number two, I think they actually have it backward. And so we'll see. I mean, I just find it to be very interesting. And I'm looking forward to it. I can't wait for it to happen. I am not bearish. I would be bearish if I see a significant drop off in the fiscal flows. I don't see that. We're going to get an increase. So we just got an increase in the defense budget. We are seeing increases, not just in the United States, but in Europe now. They have pretty much jettisoned their deficit levels because they're now going to be pumping up fiscal into more defense and security and this kind of thing because of the war. So I just don't see a big reduction in fiscal, not here, not globally. And to me, that just says we're going to have decent economic growth. Yes, inflation will be a drag on economic growth, but I don't think it's going to be a drag to the extent that it'll push us into recession. And I think the stock market, I think risk assets are going to react favorably to that. So I'm looking forward to it. I mean, I've been saying that, and I mean it. And we're going to have this conversation, or we're going to look back at this conversation. We'll look back at these videos, by the end of the year, or maybe, in the fall. And we'll have a look at what's going on with the economy, what's going on with inflation, and how the impact of this monetary policy shift, what the impact of this monetary policy shift will be. And I don't think I'm going to be surprised. I mean, I might be, but I really don't think I'm going to be surprised. I think who's going to be surprised are the Fed members, Powell and Lyle, Brainerd, and the rest of them, who really, and also the vast, community of finance who are just almost psychotically focused on monetary policy. I mean, that's all you ever hear about it. I mean, every little zig and zag in the market on a daily basis, not on a long term, because on a long term it's just going to reflect the fundamentals of a growing economy and growing corporate profits. But every zigzag on a daily basis, that is 100%, or I should say 99% focused on monetary policy. Maybe the other 1% is on this war. And that's, you know, the war is real. I mean, it has the potential to spiral into something that ends up with the annihilation of the human race. That's no joke, all right? And I mean, that makes everything we're talking about here totally a moot point. Like it's you know, it's meaningless in the big picture if it ends up, you know, leading to nuclear war between the two nuclear superpowers on this planet. I mean, we're all fucking dead at that point. I try not to think about that, man. It's just, what's going on is crazy right now. Anyway, so that was the news today. Not surprising. You got a market sell-off. This is, you know, it's your typical knee-jerk reaction. People hear this stuff. This is not smart investing. What I did today was I had orders, you know, as the market started coming down, I put orders in for stocks that I hold at below, you know, the lows of the day. I got filled on just about everything, and that's how I like to play it. You know, on down days, especially on sizable down days, I like to be a buyer. I like to add to my stock positions, and, you know, that's the way you have to do it. I say to people, you know, if you make that little tweak in your investment strategy to buy on the down days, and never chase stocks. I mean, never chase them higher, never pay up for them. Make the market pay your price. You know, I teach that. I used to teach that in my Forex course. Make the market come to you. If it doesn't, fine. But, you know, it's like a negotiation. If you go into a negotiation, you have your conditions and you stick with that. And maybe you start off a little bit away from your conditions, like, you know, farther away, so that, you know, you can negotiate to where you get what you want. But don't pay up. Never pay up. I mean, there's plenty of opportunity, and there's no sense to pay up. When you pay up over time, you're just going to lose money. Anyway, that's it for today, folks. All right, let's go. See you tomorrow. Bye.